back, time for a check on regional markets, and Asian shares are lower on profit-taking after the S&P 500 failed to hit a record high for the second straight day. Investors are cautious following recent weaker than expected US economic data. Japan's Nikkei index is down as the yen advanced the most in 3 weeks against the dollar. And down under, Australian shares are a tad weaker, more or less flat though, after hitting a 5.5-year high. Sentiment's being weighed by the recent sharp fall in the yuan and core concerns about China's growth. And to talk more about stocks and global economic growth is market strategist Kelly Teoh of IG. Thanks for joining us this morning, Kelly. Now, the S&P 500 is flirting with record highs despite sluggish economic readings in recent weeks. Should investors worry about the state of the economic recovery, though?
I mean, it sounds strange, but we're in a market that dismisses bad news and continues to rally. The concern I have is the undeniable trend of record low labor participation rate. The other data points that have been showing weakness is probably weather-related, like housing. But at the end of the day, if you're looking at less Americans at work, that would equate to lower productivity. However, the market has dismissed all of these with a forecast of a better year. As an investor, it's about being aware of these and just staying invested.
All right. Do you expect downward revisions on Friday to U.S. fourth quarter GDP estimates?
There's actually a real risk of this happening because of the dip we saw in retail sales of a decrease of 0.4%. The weather, again, was partly to blame, but to an extent, it has clouded spending. But if you do look at retail stocks, such as Lululemon, sales have been on a decline. So I do think the underlying issue is actually slow wage growth and employment.
And given the mixed reporting season, do you think U.S. stocks are overvalued?
If you look at the PE in 2009, which is where valuations was at the peak, it was 24 times earnings, and the S&P was trading 60% below where it is right now. So I think with PE at 19 right now, and with that perspective, it's not entirely overvalued. The issue is last year we have stocks that were going out because of buybacks and dividends, and this year it's been M&A activities. So what investors would like to see is some CAPEX from corporates. It would be good for the underlying economy with spending in the businesses as well as R&D.
So do you think stocks are going to see lots of ups and downs this year then?
Without a doubt. I think the stock market continues to inch higher, and then you've got on the flip side, the Fed is tapering. Investors are going to start to become more selective and look at stocks that have real fundamental growth. We're also entering uncharted territory in regards to the Fed on how the stock market is going at this point. So it's been called the market that nobody likes, but investors don't really have a choice.
On your note about tapering, could anything change the Fed's moderate path on tapering, do you think?
It has to be a significant event, like a meltdown of financial markets, or the unemployment picture becomes terribly bleak. I think investors welcome the Fed tapering and would like to see them exit the program in its entirety. Inflated asset prices have been blamed on the Fed stimulus, and there's also the other issue of the ballooning balance sheet of the Fed. So I think the market would like to see valuations normalize by real growth.
Now, Kelly, new home price acceleration in China's biggest cities showed its first slowdown in a year. Is China's property market cooling down?
I think you're right. I mean, if you look at both the monthly and yearly prices, it's become softer. Credit crunch for many of the developers mean that they're starting to cut prices. It is a welcome sign, though, for government officials who've been trying to rein in the property market. It wouldn't be a surprise for this to be happening right at this point just because of the slowdown in the broad Chinese economy.
And will a sharp slowdown in property investment increase systemic risks to the Chinese economy?
The risk is more of in bad debts in the banks if they start to revalue the portfolio, and the contagion effect from that. The banks that have refused developers credit was probably likely to loosen this criteria if prices drop sharply. It's sort of the aim for everybody to have the price steady and not for a crisis to happen. So I think what's more likely to happen is for dips in smaller cities where there's an oversupply.
Just one more question for you, Kelly. Gold's prices have climbed 11% since the start of the year. What's next for the metal?
Gold's really been getting a lot of interest from investors from the start of this year. It's clear that the bottom was formed in December last year. The interest we're seeing is both in the ETF long positions as well as the bullion buying. So I think what's going to happen is investors have been putting gold into their portfolio. I do see further upside in this metal and the next level at 1350.
All right. Well, thanks very much indeed for that, Kelly Teoh of IG there. And that's a wrap from me for now. Back over to Stephen Yvonne.
Thanks for that, Pat. Now we have an update next on